Good morning to our wonderful audience and welcome back to Boutiques on Wednesdays, where we bring you the top local and global boutique fund managers. I'm joining you from a very wet and windy Port Elizabeth, or rather Gqeberha, right? We had a brief introduction to Northstar Asset Management in April, where we had a look at some of their portfolios, and it's our privilege to announce that transition to the BCI family should be finalized towards the end of this week. They may be new to some of you, but they've been managing a range of mandates successfully for decades already, with a sound track record that includes several industry awards and nominees, and a highly experienced team, of which you will get to meet a bit more today, of investment professionals. Today, we will have another look at the Global Flexible Feeder Fund, which is in the Global Multi-Asset Flexible category, as well as the Local Income Fund and SA Multi-Income Asset category. Joining us now is Chief Investment Officer Adrian Clayton and Director of Fixed Income, Mark Seymour. Good morning, Adrian. Good morning, Mark. How are you this morning?
Good morning, Eugene. Thanks for having us. And
fantastic. Adrian, I believe you're going to start the presentation from your side, having a quick relook at your business, where you're from, what you do. And then I believe, Mark, you're going to continue on your fixed income and then followed again looking at your global flexible.
100%. Thank you very much. And we look forward to going through the presentation. Just in terms of the business, I'll be relatively quick. Work.
Yeah, there we go.
Just in terms of our business, our mantra is long-term exposure to quality assets where value exceeds price. That's been the case for many years, and we're not changing it. So two important features there is quality and value, and the work we do on that is really the focus of the entire team. In terms of the discussion today, we're going to deal with the income fund, which is built for all terrains. That's Mark. Mark's going to manage that, talk about that. And I'm going to deal with the global flexible fund, particularly dealing with valuations and the importance of flexibility. Just a quick synopsis of our product range. Very simple product range. We don't believe in having a lot of products. So an income fund on the far left along the risk spectrum all the way to equity funds, South African equity fund, 100% equity fund, the Northstar equity fund, and then a 30-70 equity fund doing 30% global. So, and between that, we've got a balance fund and a feeder fund, offshore feeder fund. And our global range, also just two funds at the moment. We've just launched an income fund, a US dollar income fund on the back of the top performance on the domestic income fund. And then our global flexible fund, which we'll discuss today, that's been going for a number of years. In time, we'd like to launch an equity fund, but maybe when we go through the presentation, it'll be clear why we haven't done it now. Just in terms of the team is 13 investment professionals. Obviously, we've got a large support team that's critical behind these people. But I think important for us is that, we merged with the First Avenue team beginning of the year. That's exceeded our very high expectations. Everyone follows the same process around buy lists, which we'll talk about through the presentation. And I think what's quite unique about the team is that 54% of it are people of color, which is what we should have and represent South Africa, and then more than 30% are female. And hopefully we can get that number up to 50% in time. Just before I hand over to Mark, I just want to say the two of us have been working together since 2001, and we've known each other since the 1980s. So collectively, we've run money for over 50 years, believe it or not, and I think we've seen a lot of cycles, and we learn each day, but we're still having a hell of a lot of fun. And I think hopefully some of that insight will come through today. Thank you.
Great. Okay. Hi, everybody. My name is Mark Seymour, and I'm the manager of the Northstar Income Fund. And today I'm going to be talking about how we believe that this fund is structured so that we can manage all market conditions. And I'm going to summarize specifically why that's pertinent, given that the performance drivers for the main asset classes in the fixed income space are quite different through the interest rate cycle. So looking at real returns from cash, real returns from inflation bonds, real returns from fixed bonds, etc., etc. Okay, so if we go to the first slide, just taking a look at this chart, you can see the red line is the repo rate. And so here we've got a 20-odd year history, and what we can see is that as a function of the inflation environment and the growth environment, interest rates rise and fall, and that has a material impact on the returns from the different asset classes. And most importantly here, you can see on a one-year rolling basis in the shaded blue area, that's the one-year real returns from cash. And so what is apparent is that, if you're relying just on cash or like floating rate notes to generate real returns over time, that you can get into situations where that is actually impossible. And so that's why we believe managing or having an active approach to allocating assets to different asset classes in the fixed income space is relevant and needed. This chart, so it's the same chart, you've got the repo rate and the red line, and then you've got the two shaded areas. The red is the real returns from cash, and the blue area is the real returns from fixed bonds. So straight away, what you can see here is that obviously the returns are a little more volatile. You're taking on more duration. The other fact is that you get really strong returns during periods where interest rates are being cut. But quite importantly, looking at this, by having the option to take on fixed bond exposure, you can actually enhance the returns, one. And then secondly, where I've highlighted in the green ovals, there are actually periods where you're getting negative real returns from cash, but you can generate positive real returns from fixed bonds. So by having the option of looking at other asset classes, definitely helps smooth the real returns from this fund. And then if we have a look at inflation-linked bonds, I highlight once again here the shaded blue area is the real returns from inflation-linked bonds. And what's quite interesting here is that the returns aren't strictly tied to the interest rate cycle. The experience that we've had in this South African market is that the real returns have been generated largely as a function of being able to pick up these assets when real yields are high. But I think in terms of this chart, what's quite important is that I highlight three areas where inflation-linked bonds have given you real returns where cash returns have been negative. So once again, by gaining access to inflation-linked bonds, you get that diversification and smoother real return profile. This graph is SA property. What we can see here is the shaded blue area, real returns from property, as you can see, a lot more volatile. So, if we are thinking of holding property, one needs to do that with caution. The other take-home points here is that, from 2003 all the way through to 2015, you had really strong returns from property. And that's largely as a function of the strong economic growth. And also after the GFC, there was a strong rebound in distribution growth. So, that asset class was well rewarded. But definitely, since 2014, 2015, with GDP growth dropping off a cliff and also valuations being very expensive, property also, decimated returns in real terms. So, yeah, and so I think what I'm demonstrating here is that by considering different exposures to different fixed income assets, you can enhance returns. This slide is the historic, it only goes back 6 years. We do have a 9-year history with our Northstar Income Fund, but this is over the last 6 years. It shows you that we demonstrate here that we have actively allocated across different fixed income assets. And I'm just going to talk very briefly how that has added value. So if we go back to 2017, the shaded areas, the blue floating rate notes, close to 50% of the fund was in floating rate notes. At that point in time, the SARB had the central bank rates at a very nicely elevated level. So you're getting really decent real returns out of cash, floating rate notes side of the market. And then the next largest exposure was fixed bonds. And if you roll that forward all the way through to just pre-COVID, you can see that the inflation-linked bond exposure, which is the pinky area, that was meaningfully picked up as real yields started to look more attractive. So this demonstrates how active we have been. And I'll explain shortly in terms of our investment process, what drives that, and how that's added value. Okay, so this is it's quite a busy slide, but it summarizes some of the main steps in our investment process. First port of call is that we've got a strong or long data set going back to 1960 in terms of the main asset classes and the performance that has been generated out of those asset classes, and also more importantly the interaction between those asset classes. So from a risk perspective, we understand what mix of assets will likely give us our required return. Second step is we've got we position the fund on a forward-looking basis, so we understand the performance drivers, and I've just demonstrated, as you go through the interest rate cycle, you certainly have different drivers pushing different asset classes. Third step is we got a strong sense of what the valuations are and the return expectations. And then every month we do a portfolio optimization exercise where, based on the expected returns, the fund asset class weightings are blended so that we maximize the return for our target level of risk. And that's what we do. This table is also very busy, but it demonstrates the different asset classes that we put through our optimizer. So just for the record, we work off a buy list for every instrument and all the portfolios. We've got a valuation which translates into an expected return. For the sake of the portfolio optimization, we approximate the underlying components at an asset class and maturity bucket. And so this is just an example of the numbers that we've looked at over the last 2 months. So the far right-hand column, the returns as of the end of June, and the next column as of the end of July, the return expectations. So by getting a strong understanding based on, in the fixed income space, largely as a function of interest rates and inflation, and also sovereign risk, getting to a return expectation, those numbers are put into our optimizer. So in this chart here, the bottom left-hand chart is a number of different random samples of those different asset classes with those returns. And what we do is, based on our return expectations from the Northstar Income Fund, targeting a standard deviation of 3%. We've done the homework in terms of the risk and the returns, and that's most appropriate. Based on our numbers, the forward expected return, blending those assets, gets us to where that little blue dot is on a return versus standard deviation chart. And so you can see that gives us a very good idea in terms of our take on the different return expectations as to how to construct the portfolio. So that's forward looking. The top left-hand chart shows you that asset class mix. I'm not going to go through it all, it's quite busy, but basically it's a blend of inflation bonds, floating rate notes, fixed bonds, and then some alternatives and offshore assets as well to minimize the standard deviation. The top right-hand chart demonstrates the same mix of assets, but on a different set of axes, so return versus drawdown. So based on historic numbers, this blend of assets limits the drawdown to within 3% as well. And the bottom right-hand chart just gives you that drawdown profile of that mix of assets. So, all the work that we do goes into understanding the performance drivers, the returns, and the work goes into constructing the portfolio on a forward-looking basis. And essentially what comes out of this exercise is an active approach to allocating assets. And it's the same process that we do across all our multi-asset funds at Northstar. This chart is just a risk return chart, historic. I think this is 5 years. We've demonstrated that we can outperform. So we've been outperforming our benchmark, which is cash times 110. And we've managed to do that over the longer term in the range of about 1.8% after cost. And then also relative to peers, being very competitive and at the same risk profile. It's also important to note that we're very differently positioned. The portfolio is actually very light on credit. So I haven't spoken about how to enhance returns in terms of credit, but that's another lever that we can pull. But just to give you an idea that most of the returns have been generated out of being able to navigate the different asset classes as opposed to taking on high credit risk. And then this is just a closing slide on the Northstar Global Income. Adrian mentioned that we launched that recently. This portfolio seeks to do exactly what the local income fund seeks to do. It's an inflation +2 target. I'm not going to talk too much about it, but exactly the same asset allocation process and valuation processes drive the positioning of this fund. And it's actually had a very nice start since launch. Thanks very much.
Thanks, Mark. All right, I'm going to move on to the Northstar Global Flexible Fund and give you some insights into how that's been going. The fund's been around for 5 years. We've obviously run global money for many, many years, much longer than that, probably 15, 16 years. And some of that's reflected in our managed funds performance. But just in terms of a pure offshore fund with a performance track record in dollars, and this goes back more than 5 years, and we'll talk through that. All right, just in terms of what I think is important in the presentation, there's a lot of slides and often a lot of detail, but flexibility is important. And while we will launch a global equity fund at some point, we think it's critical right now to have the flexibility that we think is required in the markets, and I'll talk specifically to that at the back end of the presentation. Just in terms of how this works, again, not into kind of deep detail of it, but we do a lot of bottom-up stock selection. We focus on company valuations. The whole business revolves around buy lists, and we're really trying to get an understanding of each company's valuation against the current price. And we work out bear cases for businesses, base case valuations, and bull case valuations. We also work out a probability weighted return, which is a percentage of each one of those valuations in terms of a probability. So, if the analyst thinks that the probability for a bull case is very high, the probability weighted return will be biased towards a bull case. So that exists on our buy lists, which are live on our screens daily. There are 100 stocks in global on those buy lists, 100 stocks in South Africa, and then we have a full fixed income buy list too, globally and domestically. That process drives asset allocation. So because we're looking at all the asset classes and have a fixed income team, a global team, and a local equity team, we can compare asset class performances in rand terms if we're running a South African fund, or in dollar terms or sterling terms we're running offshore funds, and compare asset class returns to each other and get an asset allocation overlay in our portfolios. At the center of our business is Alex put the brain in there, which I think Alex is runs distribution for us and his little picture is the brain in the middle, which is our buy list, and he's spot on. The whole business focuses on the buy list. Everything that everyone does, other than our support staff, in terms of research, you're not expected to run a portfolio on your own. Your job is to populate the buy list with best expected returns across instruments, and that buy list gets used across all our portfolios. So how do we choose securities or stocks that we want to own? We screen for them. We run persistency and recency screens, dominantly focused in the global and local space, more difficult local, on quality and growth factors. And then we rescreen on valuation. And really, it's around finding businesses that are reliable over time, generating specific return metrics, financial return metrics, which then translate into share price performance over time. The next part of that is to value them correctly. And how do we do that? Well, each business that comes up in our screening, and we get a master list of about 250 companies that we built up over decades, is then translated into a shallow dive basic assessment on valuation, which is a quick and dirty process which we've built up ourselves. If the company passes that, it goes to the next level, which is a deep dive research project. We look at the same thing for every company: the moat of the business, the management, and score them. We score the moat. An industry analysis: is the company in a good or bad industry, and what are the behavioral traits in that industry, and we score that. ESG, we price score to, and we get a risk rating on every single stock. The next component is valuation. So really what we're trying to do is value businesses, try and find out what we think they're worth, and also do a qualitative assessment of them, all of which goes into the buy list, gives us an indicative weighting, and a bear case, bull case, base case, probability weighted return. That buy list then populates all our portfolios. So effectively what we're doing here in this one slide is our buy list is telling us what to buy and what to sell, the prices that we are allowed to buy and sell things at, their expected return from every single stock on that buy list, how much of it to own, and the next part of that, it drives our asset allocation framework. So here we're just again taking a snapshot of that buy list. And really, I mean, this goes back to, we've shown this slide before in January, but it's quite interesting now because at the time Visa was a buy on our buy list, and Estee Lauder had hit its intrinsic value and was a sell. Subsequent to this, now we're in August 2023, Visa has actually gone up about $15, and Estee Lauder has dramatically fallen, and we were net sellers at the time of Estee Lauder. I will point out that our valuation work ended up being wrong on Estee Lauder. Although we thought the stock was a sell at the time, it's actually gone down quite dramatically, and the earnings have been terrible due to some Chinese issues. So, we got it right, but, sometimes you need a bit of luck. And we certainly didn't get this 100% right in terms of knowing what it's worth. It's been more volatile than we expected. Visa, we've been spot on. And you'll see later in the presentation, just the level of hit rates that we get out of our research. It's very, very high. So we do get things wrong, but we get a lot more right than wrong. The other point on this list is the intrinsic value discount, which sits at the top right-hand side of the slide. And I can't see that on my slide because everyone's faces are covering that. But there's up top right, there's an intrinsic value discount for our entire buy list. Now, this is a critical number. It's live on our screens. We assess it every week in our meeting, and it determines our asset allocation tactically if we want to adjust asset allocation weekly, but definitely monthly when we do our optimization. Now, what's important is that discount is a sum of all the discounts in the portfolio of every stock. So if we know what we think a company is worth, we compare that to our base case value, the company's share price versus our base case valuation. And then we compare that across the entire buy list. We get a view of how much upside is available on our buy list. And we follow this number quite carefully, as you can see in the next slide. So what we've got here is we've got the intrinsic value discount in blue. And what you see is that tends to move between 0 and 35%, just historically since 2016. Against that, we track it's really just an indicative equity weighting that we should have in the portfolios based on that intrinsic value discount. So it's telling us, how much equity we should have based on the discount that's available on the buy list. So when that discount is at 35%, it's a clear buy, and it's telling us to own 90% equity. When that discount diminishes and goes, to 0, It's obviously forcing us to have the lower bound of equity exposure. What's interesting is that discount's currently around about 16%, and it's kind of in no man's land, and we're kind of relatively cautious on the markets. All right, then just the next slide gives us an indication, I've got to watch my time, of Marco, who runs our domestic equity team, decided to take on discount on the buy list and assess, when what the discount delivers in terms of equity market returns 60 days out. So just compared the two to each other. And what's very clear is that going back over long periods of time, this is a short dated slide, but we can show this over long periods of time, there's a relationship between the level of the discount and the prospective returns on the market. Now, we don't look at the market, obviously, every day like this in such a short basis, but what we're trying to show is that when the discount is large, you should be buying the market. And so the proof's in the eating in our buy list, it works. All right, then the next slide is probably a particularly interesting one. And it really just asks the question, can we pick stocks? So what we've done is we've shown a few slides, graphs here. The top left-hand graph is the performance of our equity portfolio within the flexible fund, going back to 2013. So we also use data in our managed fund to create this. And what's quite clear is that it shows the bars of positive alpha versus negative alpha. And we have generated negative alpha in certain years. And I'll talk specifically to those points. But what's quite clear is if you look back over all these years, we've generated a lot more positive alpha. The 11 years of positive alpha, or 11 years of data and 3 years of negative alpha. And I think it's important to actually understand what went wrong in the negative years, or if something did go wrong. Then we also look at the hit rates. What percentage of our stocks have outperformed the MSCI all country? That's the percentage, and any hit rate over 50 generally for managers is good. We often get 70%, which demonstrates a high hit rate. That's what I was saying earlier on. And then the right graph looks at our win-loss ratio, and really it's our positive alpha, cumulative positive alpha, or sum of positive alpha over the negative alpha from stocks, and that should be above 100. Some years it's not. The bottom graph shows in red our outperformance of the large cap manager, the sector, as well as the MSCI All Country World. Now, just in terms of the negative years, and I think I want to talk to that very specifically now, because I think it is interesting. Our negative years were in 2014, and that was just own goals. We made mistakes, but our hit rate was still above 50%. So we were getting most stocks right, but the stocks we got wrong, we got really wrong. And that hurt us. And a lot of work has been done since then to improve that kind of outcome. But more importantly, 2021, were we terrible? Were we really terrible, or is there something else at play? Now, 2021 is interesting because the global markets returned 22%, and energy did 42%. Now, you can imagine if we're looking for stable, long-term returning companies, you're not going to find too many oil stocks in there. 42% from energy, and tech did 30%. Now, tech is 22% of the all country. So it's the biggest component. So if you're not overweight tech, you can really be left behind, and tech can be extremely expensive. Now, what's interesting is the next year, energy continued to do well, did 48%, but we had a huge year in 2022, and we outperformed the market, despite oil's, I think, 5 or 6% of the all country world. But tech was down 31%. So we bounced back that very next year. Now, this fund generally has staples in it. It's got industrials in it. It's got pharma, and kind of med tech. So you're dealing with more stable businesses with earnings profiles that are reliable over time. Tech, on the other hand, often can be quite cyclical. So this year in the markets, 2023, what's been fascinating is we've seen a repeat of 2021, excluding the energy trade. Energy has been terrible this year. But global markets, depends what data you use, but we're up 19%. Tech did 43%. I mentioned that at 43% this year, 22% of the index. Communication services done 38%, and consumer discretionary 33%, with Tesla's in there. Whereas consumer staples, which we have a lot of, 6% return, healthcare 2%, and industrials 18%. So that, again, you're seeing the same repeat of 2021. the stock sectors that we have the predominant exposure to, and which we will continue to have over time, have underperformed the market dramatically. Our hit rates remain higher than the market this year, believe it or not. And some more interesting points is that more than 50% of the stocks in the US are actually down year to date. And you've had 7 stocks drive the entire market. The tech index, relative to its long-term average performance or multiple against the S&P, is 1.6 times against its long-term average of 1.2 times. And it's the biggest outperformance of cyclicals against defensives in almost 10 years. So, you have a very interesting dynamics taking place in the markets. And in the second quarter, the performances of top stocks were NVIDIA at 68%, Tesla 63%, Alphabet 23%, which we did own, Amazon 27%, which we did own, and Oracle 24%, which we did own. The market only did 8.64% in quarter two versus those stocks. So you can just see the leadership and the concentration is in very high beta stocks. For interest sake, NVIDIA, that is up 221% this year, was down 66% in the 18 months preceding that. Just to give you an idea of the level of volatility of some of these stocks that we're facing. All right, just moving on. Our asset allocation framework, same as what Mark showed, all the different asset classes and securities in there. We then bring it into an optimizer. We target a standard deviation of about 11% in this fund. It's about, call it 60% of the risk of the markets, which could lead to a 28% downside in the fund in any 12-month period. Asset allocation has been active over time, and I'm just going to point out a few things to you quickly. The introduction of credit during COVID, the introduction of inflation linkers at that period, and then the introduction of gold in the last few years, all of which have worked out very, very well. So I'm going to find out, the portfolio is done as well as equity managers globally, but yet it runs at, call it 60-65% in equities. And the performance is very clear to see. It's that funny looking dot on the far left-hand side is us, but by the way, if you're trying to understand the graphs, relatively low standard deviation, high expected returns in our sector. I'm going to just leave you with some last points of why flexibility is important. The market's been booming, but earnings typically fall 15% in a recession and the PE contracts 30%. We think the market's expensive. PMIs right around the world are rolling over across all geographies. Money supply, albeit at extremely high levels in the system, have gone negative in terms of annual year-on-year growth. And COVID savings that represented 12% of household incomes in 2021 are down to 4%. And we can continue a long list of things to be super cautious for right now. So we just, we've got 60-odd% exposure in the fund. We're happy with what we own. We own cheaper stocks. We wouldn't be surprised to see a big reversal of our performance next year. Again, we think that there's a play on in the markets of the cyclical reversing and the defensives coming back into play. Thank you.
Mark, it was a whole mouthful right there at the end. And in so many words, if I understand you right, it's not really the time to try and chase this market or Magnificent Seven. Rather trust in a flexible fund to manage those allocations for you. I know a lot of clients out there feel that they've lost out. Maybe just quickly back to your valuation process, and I found your slides very insightful, and it obviously works for clients, and it does show that you can pick stocks. Does your process then imply that you won't buy into those higher price stocks like the Metas and the Microsofts and the NVIDIAs at this point of time?
Yeah, Eugene, we certainly do own Microsoft. We've owned Meta before. We will buy a business if it's a good business that's trading below intrinsic value. And, in this tech sell-off, we actually bought quite a lot of tech. And we've been net sellers of tech again in the last few months, despite the big run-ups and those. So we have no problem buying these businesses. But the process is very discerning in terms of not overpaying for them. And, Mark, we know how markets work. They dislocate from valuations at times when there's cyclicality and exuberance.
Makes a lot of sense. Just very quickly, your views on energy from this point forward over the next 6 to 12 months?
So energy is not owned in our portfolios from the fundamental portfolios. I mean, it's very clear that energy prices have risen again. It's also clear that, you know, we've got a strong demand for oil, continued strong demand, and long-term relatively constrained supply. We understand all those dynamics. And, you know, I suppose for a certain type of manager, those stocks do make sense at times. But they remain very cyclical businesses, and they don't find their way into our fundamental portfolio. We think we can make enough money with what we're happy to own than diving in and out of energy.
You did mention that you are slightly or a bit more cautious at this point of time, and it does speak, I suppose, to that healthy allocation to your global income fund. Mark, if you could maybe just, I find that fund very interesting, especially given where we are on the yield cycle. Just your views on global fixed income this point forward. Do you think we're going to get more surprises in the global yield curve? I mean, the Fed said they might increase rates, you know, another 1 or 2 times before the end of the year. Do you think that's in the price already?
Okay, so there would be a lot to unpack there. Maybe we probably won't be able to get through all those details.
In a minute.
But okay, in a minute. Essentially, what is the good thing though is that literally in more than a decade, for the first time in this space, in the low risk space, you can actually generate real returns. That's the first protocol. So you know, US Treasuries, short dated US Treasuries on yields above 5%. That's a good starting point. I'm a little skittish about longer dated yields. I spoke, if we go back a year. I argued that yields could rise above 4% at the 10-year point. That's proven to be the case. And I suspect that over the short term that there could be ongoing volatility there, and you could potentially get a better entry point. But we are getting decent yields out of US Treasuries. And then the second port of call is that, you know, we've spoken about the market being led by the Magnificent Seven, but there is a large segment of the market which is actually very cheap, very stable dividend payers, and on very decent dividend yields above 4%. You know, that obviously comes with risk, falling, lowering, you know, obviously economic activity. But for the first time in a very long time, you can actually construct a portfolio that has a good chance of delivering decent real returns. So we're quite excited about having just launched that fund, and yeah, I think the timing's good. Yeah, but there are risks that need to be managed, and our asset allocation process sits on top of, you know, everything we've been talking about: buy lists, expected returns, and also just sticking to a risk framework. So yeah, you know, so that fund is on a yield of just over 4%, and a large majority of that fund is exposed to short-dated US Treasuries, and it's a market we'll be looking closely at. Whether the longer-dated bonds are priced in, as per your question, is still to be answered. But yeah, I mean, we're close to the top of the interest rate cycle, and at some point, you know, it'll be, you know, back to the races. Some longer-dated bonds coming in and some really decent returns.
Mark, it's definitely a conundrum at this stage, but it's very interesting how all that comes together in your global flexible fund. I'd rather you manage that for me. Maybe very last question quickly. You've got a couple of other mandates as well. I know we haven't got enough time to unpack all of them, including in that you've got a Reg 28 fund as well, the managed fund. Just from your optimization model, from a ZAR investor perspective, given the current weak levels of the rand, what is that optimum or that model kicking out in terms of onshore, offshore mix?
Yeah, okay, so I mean, it's a very good and it's a contentious question at this point in time.
Yeah.
Everything we do is from the bottom up and based on expected returns. And so, you know, one thing we do appreciate that if you look at history, and we're talking going back to 1960, the optimal weighting that one would have had in this sort of balanced fund space would have been a 40% offshore allocation. That's to offshore currencies, global equities and global bonds, so not just US related. But on a forward-looking basis, the answer that you get is a slightly skewed away from that 40% exposure. And based on our return expectations, so that's in Rand terms, what we find is that it's a weighting that's lower than 40%. So we're sitting at a weighting to offshore assets, which is typically lower than the 40. So we are not in the camp of trying to get 45% exposure to offshore, and that's just simply as a function of our return expectations. So, you know, I'm sure at some points in the next year or two, the balance fund may end up with a 40-45% offshore exposure. So, yeah, it's an interesting one at this very point in time, just as the regulations were relaxed. You know, arguably valuations kind of, into our minds, mitigated taking that full 45% exposure. But the markets are, you know, they do what they do. They're quite volatile. They present opportunities. And, you know, based on our month-to-month work, those allocations do migrate up and down.
Very interesting indeed. Gentlemen, we are unfortunately running out of time. I can keep you busy the whole morning. It's really insightful to see what you do in your portfolio. It's exciting times. And from our side, we're very excited to have you join the BCI family and looking forward to seeing a lot more of your funds in the very, very near future. Mark and Adrian, thank you so much for joining us this morning in your time. We greatly appreciate of it. To our audience out there, very quickly a reminder, next week, Wednesday, the 30th of August, we're going to have a look at what Core Shares does in the select fund range. And don't forget to register for the upcoming live events in September. If you're not sure, give any of our sales team a call and we can get those details through to you. Again, to Adrian and Mark, thank you so much for joining us. To our audience out there, your continued support, and the BCI team for setting us up. Thank you so much. And we'll chat to you soon.
Thanks so much.
Thank you.